Joining us now to talk more about the markets and how to invest in this environment, Bob Bauer is Principal Global Investors Chief, Global Economist, and Rich Peterson is Standard & Poor's Director, Markets, Credit, and Risk Strategies. Gentlemen, it is always nice to have you on the program. Welcome. How would you characterize the economy right now, Bob? What are you seeing?
I think we're in a recovery that's going to be self-sustaining. We think there's some momentum in the economy. Inventories are going to start coming back at some point. Housing and autos are already adding to economic growth. We think there's some pent-up demand for capital spending, and we think this is going to be a self-sustaining recovery.
So what does that mean for the stock market then?
Well, we're reasonably bullish on the stock market going into next year. If there's a setback, we view that as a buying opportunity. We look forward to...
So what sort of gains? What do you think we might get in the S&P next year?
Oh, that's hard to justify. That's hard to know.
What's the order of magnitude?
Oh, I think a 10% gain is certainly something that could happen by the middle of next year. The reflation trade, we think, has probably got another 6 or 7 months to run.
Yeah, it's interesting because there's so many optimistic forecasts out there on the heels of what we've been seeing, a stock market that is rising, an economy that is showing growth once again, and yet you still have weak spots around the world, and we're still waiting on revenue growth. So how do you want to be invested specifically? Rich, how do you see things?
Well, right now, I think what we're seeing is a recovery, but an anemic recovery. Now, the expectations are the risk that we can see a decline from the 2.6% growth in the third quarter, and going into 2010, there's some headwinds. Obviously, the joblessness is a concern, the ability of the consumer to participate is a concern, the risk of the Fed may hike rates sooner rather than later, may cause a turmoil in the credit markets. So obviously there's concern. That being said, obviously we had a great rally, obviously up 64% from the March lows. But you look at the activity in the fourth quarter. Financials have been the laggard. The only sector in the S&P 500 down this quarter. Healthcare has been the best performer.
We have insight there because Jeffrey Immelt has just said that the worst is over for financials. But when he also says that GE's industrial profit next year is going to be flat on what we got this year, what insight does that give you as to the mind of these very big CEOs?
Well, I think their concern is the ability for governments to spend in a way that can generate economic growth. I think the fact that we're going to see maybe a 2% growth, maybe perhaps next year, and the risk again. Look at just the capitals that are raising. We talked about the dilution out there. That's going to be a concern, maybe some corporate earnings. We have in January, we'll have the first numbers coming out of Alcoa, so we'll probably get some indication of how well the fourth quarter is. But the fourth quarter of 2009, in comparison to a year ago, is no comparison at all.
Right. It's night and day, right? Yeah. So let me ask you this. I mean, Simon's making an important point, and that is the heads of major corporations are out there saying, yeah, I feel better about things than I did a year ago, but at the same time, we're looking at a flat situation in terms of industrial, even if we have seen the worst. So,
sure, but in some respects, those forecasts are really kind of an image of how people think today. We think profits are going to be much better than people think, as they have been in the second and third quarter.
What's the biggest risk to the economy and the stock market in 10?
Actually, we see what's coming out of Washington. Tax hikes clearly on the horizon, substantial industrial policy that's a little bit capricious. We don't know for sure if the Fed's going to find this baby bear speed of withdrawal of monetary liquidity or not. So if they're too fast, it'll hurt the recovery. If they're too slow, it'll continue blowing some bubbles. So we think the Washington risk is probably the biggest at the moment.
Which is the point you were making as well.
Right. And it's just the uncertainty because you don't know what the end game with the healthcare is, the tax hikes, and if regulation comes, re-regulation.
We'd be a little more optimistic, though, on the worker side. We think we're going to see job gains starting in January. The leading indicators of employment are much better.
We have to leave there, Rich. Thank you very much.